Welcome to our Hurst Cycles webinar for the 9th of July 2018. My name is David Hickson, and as always I must ask you to please make sure that you have read and understood these disclaimers. In today's webinar we're going to be taking a look at the S&P 500 again. Today is the final webinar in the current season of webinars, if you like. I know that many of you have been asking me to take a look at other instruments, and I plan to do that, and in trying to work out the best way of doing it, I've decided that I'm going to adopt a slightly different format for these webinars moving forward. But today's webinar is the final one of the current season, if you like, in which we're going to take another look at the S&P 500 and update our analysis and consider what we are expecting to happen next. So here is the S&P 500, and this is the default analysis that Sentient Trader is performing. In other words, I haven't influenced this analysis at all. I haven't pinned any troughs or peaks. I haven't told Sentient Trader to adjust the analysis. It's the analysis that we've been looking at over the past many months, because we started really focusing on the S&P 500 way back in November of last year and started talking about what we were expecting to happen. Of course, back in November we were discussing an approaching peak, which did of course happen. Here is the big peak that developed, of course, at the end of January, and the market then dropped quickly down into a low at the beginning of February, and since then the price action has been very much sort of consolidatory in behavior. It's been describing something fairly close to a triangle, some kind of consolidation. And in our previous webinars we've been discussing the trough analysis, and in particular where the 40-week cycle trough has occurred in the market, whether it has occurred or whether it is still due, whether it's still expected, all that kind of thing. I'm not going to repeat all of that because you can see it all in our previous webinars. So the current status of the analysis, the default analysis that I'm not influencing at all, is fairly interesting, because here you can see the circle of the 40-week cycle trough that we have discussed in previous webinars, very close to this rather tempting trough on the 3rd of May, but it is the biggest magnitude trough in this nest of lows that we can see over here, and that nest of lows is centered around last week, really. If you work out, the sort of center of gravity of that nest of lows, it's pretty much centered around last week, perhaps over the weekend, or even extending into the week or two ahead of us. The important thing is that that nest of lows is warning us to expect a trough of possibly 40-week magnitude. Or maybe a lower magnitude, and I'm going to come back to that a little later in today's webinar and discuss that again. But the important thing is that we were expecting a trough to form in terms of the trough analysis, and there has been some uncertainty about the placement of the 40-week cycle. Now the peak analysis is also really interesting, because it shows us a 20-week cycle peak circle over there, which we discussed in the previous webinar. A very interesting circle and whiskers, because there are hardly any whiskers, and the reason for that, as discussed in the previous webinar, is because the 20-week cycle itself has been beating with very great accuracy, or I should say in the analysis the 20-week cycle peak has been found to have occurred at very regular times, which means there's been very little variation in the wavelength of the 20-week cycle in terms of the peak analysis, because of course we're looking at two separate analyses on this chart. There is the trough analysis at the foot of the chart, and there is the peak analysis at the top of the chart. I've discussed that in previous webinars as well. As I mentioned in the previous webinar, don't put too much emphasis on the fact that that 20-week cycle peak has been so accurate. what has probably happened, and we're not going to waste time today going back and looking at every single 20-week cycle peak, but what has probably happened is that some of those peaks are not really very well defined peaks, and so it's possibly coincidence that a circle is so so sort of accurate, or at least the whiskers are so tiny. But it was very interesting, as I mentioned in the previous webinar, that 20-week cycle peak was right over there. And of course, a peak did form in the market at that time. The chances are very high, in my opinion, that the 20-week cycle peak therefore did form back in early June. But as you can see in this analysis, Sentient Trader hasn't yet confirmed that peak, and it's still showing us a nest of highs here, and the market is now moving up, of course, and so it is possible that we're still moving up into that 20-week cycle peak. Now, in our previous webinar, we took a look at some composite model lines, and after a long discussion about the various possibilities for the analysis, I came to one fairly clear conclusion in my mind, which was that we were expecting a peak to form in early June, which is what happened, and I was expecting a second peak to form in early July. Now, because of the different analysis possibilities, I pointed out that those were two peaks that we were expecting. It was difficult to say at the time whether the July peak would be lower or higher than the June peak, and that would depend on the different analysis possibilities. But that was really the result of the analysis that we were looking at. And so we did indeed see a peak that formed in early June, and now prices rising up into what is going to end up being another peak at some point. And so our analysis gave us some good sort of footing in terms of what we could expect from the market. So this is the default analysis, as I've mentioned, and let's take a look at some of the other analysis options. I'm not going to go through in great detail a discussion of the 40-week cycle trough and where it could be placed, because that's what we did in our previous webinar. In today's webinar, I'm going to look forward, of course, and discuss what we're expecting to happen next. But let's just refresh ourselves in terms of what the different possibilities are for that 40-week cycle trough. Here is another analysis possibility that we discussed in our previous webinar, which positions the 40-week cycle trough here on the 3rd of May. I discussed that at length, and the way in which I got Sentient Trader to do that was to leave the 20-week cycle, or to pin the 20-week cycle trough here at the end of December 2017. I still think this is a possible analysis. I still think it's a valid analysis. It gives us a rather imperfect cycle shape, as you can see, and I discussed this in the previous webinar and pointed out that when you get a triangular type of action, and I call it triangular as opposed to actually calling it a triangle, because there are specific definitions of triangles in classical technical analysis, and this triangle doesn't necessarily meet all of those definitions, but it's a fairly triangular price move, and I pointed out that often the final and less significant of the price troughs following a triangular price move is often the trough of the greater cycle. And so this is an interesting analysis. It's still a very valid analysis. What I quite like about this analysis is that when we went into the new year, in the beginning of January this year, I was discussing the probability that the 20-week cycle trough had formed at this exact position over here at the end of December. And I always quite like analyses, that have some history to them, so the fact that in January of this year I was identifying that as a 20-week cycle trough means that I'm still fairly interested in this analysis. It hasn't really been rendered completely incorrect. In fact, the only thing that really looks wrong about this analysis, as I mentioned in our previous webinar, is this little period of time here, where for the 9th of February, price dropped down so strongly. And as I pointed out, that was following a very emotional tumble in the market, and it's possible that that excess emotion, caused the markets to move a little further than perhaps they should have, based purely on the influence that they were getting from the cycles. So it's an interesting little sort of aside, perhaps, as to why this analysis might still turn out to be the correct one. I received an interesting email about the possibility that the 40-week cycle trough might have occurred here at the end of May, which wasn't a possibility that I presented in our previous webinar. It's a lower possibility option, in my opinion, and I'm just going to spend a moment explaining why. It is certainly a valid possibility, and it has quite a nice look to it because it has the 20-week cycle trough over here. It has the 80-day cycle trough over there at the beginning of April. The beginning of May is the 40-day cycle trough. And what's nice about that is that beneath each of the sort of prominent troughs in price, we are getting fairly prominent troughs in our analysis, which is certainly one of the sort of indications of a good analysis when you see that happening. The reason why, although this looks like a good analysis and gives us very nice, good, clean troughs over here, the reason why it's not my preferred analysis, my favorite analysis, is because of the fact that the 40-week cycle trough itself is positioned below such an insignificant kind of a trough. Not only is it insignificant, but it bends the rules slightly, in my opinion, in terms of where fairly large troughs tend to occur in price. And let me just explain what I mean. There isn't a great deal of difference, really, between the trough at the end of May and the trough at the beginning of May. But I believe there is a fairly important difference, and here it is. The trough at the end of May is the sort of final downward move, as I've already mentioned, in this triangular consolidation price movement. And that, in my experience, is more often the position of the big cycle trough. Okay? Whereas the trough at the end of May was the first trough that formed after price broke out of that consolidation sort of move. So that consolidation lasted from early February, or you could even start it right up here at the end of January. So it basically covered 3 months, and then price broke out of that by crossing that trend line over there, and then it came down, which is of course what almost always happens when price crosses a trend line. It'll often come back to it. And so the trough at the end of May is the coming back towards the trend line before continuing on its way. In my opinion and in my experience, the big troughs formed by cycles tend to happen at this last trough in the consolidation pattern, and only very rarely have I seen them happen in the first sort of correction after the break out of the consolidation. So for that reason, I'm a little reluctant to accept this as my preferred analysis. And the other reason why I'm a little reluctant to accept it as my preferred analysis is because of the FLD. Of course, you know that I'm a great fan of the future line of demarcation, and in particular, it has to do with the way in which price is interacting with the 20-day FLD. Now, it's a fairly subtle point, and it doesn't by any means completely invalidate this analysis. But generally, what happens when price bounces out of a fairly important trough, such as the 40-week cycle trough, is you'll get a strong move up, followed by a period of time when price I've turned off that FLD, which wasn't really what I meant to do. So you get, let me turn off the pen, turn the FLD on again, and turn the pen on again. Okay, so you get price crossing up above the FLD. Then price will come down and it will find support at the level of the FLD. This is, of course, what we call a B category interaction between price and the FLD, where price finds support at the FLD. And then it will continue in its upwards movement. So you get an A category interaction where price crosses neatly above the FLD, B category interaction where price finds support at the FLD, and then a C category interaction where it continues upwards. So my hesitation about this analysis is that under this analysis we're not seeing the correct interaction between price and the FLD. Of course, this is a fairly subtle point. It's certainly not something Hurst ever mentioned. It has to do with my personal interpretation. The FLD trading strategy is my personal approach to observing the way in which price interacts with the FLD. And so, this is not a textbook invalidation of this analysis. So it is a valid analysis, and it's certainly an interesting one to keep an eye on. And in our previous webinar, we spoke about this analysis, of course, which is very similar to the previous one, which has the 40-week cycle trough at the beginning of May. And I also discussed this possible analysis, which has the 80-day cycle trough at the beginning of May. So I hope you're not feeling overwhelmed by all these possibilities. I'm now going to summarize and I'm going to make sense out of all of this, I do hope. The important thing when you are tracking many different analyses is to ask yourself, what do all these analyses tell me to expect? What are they all saying? So let's spend a moment speaking about that. This analysis, which is the default analysis, I haven't messed with it. This is what Sentient Trader does all on its own. This analysis has a nest of lows centered, as I mentioned, pretty much around last week, telling us to expect a trough of 40-week magnitude to occur. Okay, a trough did occur. Not last week, it occurred about 10 days ago on Thursday, it was near the end of June. Okay, so this analysis is telling us, all right, we're looking for a trough, probably a fairly important trough to form in the market. And when a trough forms in the market, what do we expect? We expect price to go up. Okay, so that was the expectation that we had 10 days ago, and it looks as if though it's certainly coming true. As I mentioned, we were looking at a trough to form in early June, and we were looking at another trough to form in early July, and this analysis is still providing us with that same expectation. We have had I said trough and I meant to say peak, I beg your pardon. We were expecting a peak to form in early June and another peak to form in early July, and we still have the same expectation. Nothing's changed over the past month. We had a peak at the beginning of June, and you can see the nest of highs over here for a 20-week cycle peak. And so price is now moving up into that. So that's the default analysis. Now let's have a look at the next analysis. What is this analysis telling us to expect? This analysis is telling us to expect from this nest of lows an 80-day cycle trough centered around last week. It's a very nice, neat, accurate nest of lows, which of course I've drawn over so you can't see it. Let me try that again. As you can see, it's a very neat nest of lows, really sort of accurate. I love it when I see a very neat, accurate nest of lows like that, because it tends to indicate that the rhythm that has been found in the analysis is, it's very fine. It's fairly close to all the cycles are experiencing wavelengths that are very closely related to the harmonic ratios that they are expected to have. And so it is often an indication of a good analysis. And so we were expecting an 80-day cycle trough to form. Up here we have the nest of highs for the 20-week cycle peak. So this analysis, despite being different from the previous analysis, was giving us the same expectation. slightly different magnitudes in terms of the trough, but it was telling us to expect a peak to form, a trough to form, and then price is going to move up into that expected 20-week cycle peak. Okay, I need to try and make sure I get the words trough and peak correct at the right time. Makes a bit of a difference. Okay, now what about this analysis? This analysis I've already spent a bit of time indicating is not really my preferred analysis, but it's certainly an interesting analysis to watch. And this analysis provides us with a slightly different expectation, which was for a trough of only 40-day magnitude to occur at pretty much exactly the same time, early last week. All right. And then we're going to move up into this nest of highs over here for the 20-week cycle peak. So the expectation is slightly different, but I hope you can see it's really very similar. The only difference has to do with the magnitude of the trough that was expected to form last week. Let's look at our next analysis. Here we have exactly the same expectation, an 80-day cycle trough and the 20-week cycle peak that price is going to now move up into. And our final analysis, and let's see if I can switch to that chart. There we go. Our final analysis, very similar to the default analysis, was expecting a trough, a little bit of a messy trough, a messy nest of lows, I should say, for the 40-week cycle, and that was based just ever so slightly earlier, certainly raising the possibility that this trough over here was a trough of, in terms of this analysis, a 40-week cycle. This analysis, interestingly, has already positioned the 20-week cycle over here in June, and so now the market is moving up into a 40-day cycle. Of course, we must bear in mind that these cycles, these multiple cycles, are always constantly influencing the market, and so we're going to have the price come up into the 40-day cycle peak, then it will come down into a 40-day cycle trough, then it will come up into the 80-day cycle peak, and then it comes down into into the 80-day cycle trough. So we're going to get that constant up and down movement, which is of course what we experience in the price movements of all markets. So the summary really is that all of these analyses have been telling us to expect a trough. Probably it should have been expected early last week. In fact, a trough did form over here on the Thursday of the week before. That was the 28th of June. So a trough did form there. We were expecting a trough on all of these analyses. So that really brings me to the point that I want to make in today's webinar. In these previous webinars, I've been talking at length, and I know I can tend to go on a little bit. I've been talking at length about all the different possibilities and where the 40-week cycle might be, and I know some people have responded by feeling a little disheartened because they feel that Hurst cycles is just giving a whole lot of different possibilities, and it's causing more confusion than it is resolving. And so the point that I really wanted to make in today's webinar is that in fact Hurst cycles do the converse. They do the opposite of causing confusion. And I'd like to point out two ways in which I personally use Hurst cycles to look past the confusion that might be caused by the fact that we have so many different possible analyses. First of all, the first point to make is that this is a particularly interesting time in the markets, and it isn't often that you have so many different possibilities, different analyses. I think I've got 5 or 6 of them here. That's very unusual, and as time passes, of course, these analyses will be resolved. And it might take several more months, or it might be resolved really quite quickly if price moves very strongly in one direction or another. But at some point, the analysis options always get resolved. They always do. And so we will look back and we'll be able to say with confidence where this 40-week cycle trough is. I've probably given a slightly false impression over the past few months, because I love getting into the nitty-gritty of discussing all the possible complexities of the analysis. And I've perhaps given the impression, that there's just a lot of confusion. There isn't a lot of confusion. Even though I'm looking at these different analyses, which is something I love doing, as I've just pointed out, the result of all of these analyses has really been exactly the same, which is that we expected a trough to form and then price to move upwards. Okay, I hope that's clear. So when there is, and perhaps I shouldn't even use the term confusion, when there are many options in terms of the analysis, even though the implication of each one of these analyses is effectively very much the same, how do you work with that? How do you make clear, consistent trading decisions when there are so many different options to consider? So I would like to speak about that. So let's just use this default analysis chart. And in fact, what I quite like to do when I am working with this is I just turn the phasing off. Okay, so all questions about what is the magnitude of a particular trough and all that kind of thing rather fades into the background when I'm trying to resolve possibilities and probabilities about the magnitude of a particular trough. And so what I do is I simply identify a really important trough, and you can do this with all of the troughs that you can see here, and you can get really kind of obsessive about it. But I'm just going to give you one example to show you how I use one of the aspects of the Hurst cycles approach to help me to achieve some clarity. Okay, and so what we're going to do is simply measure the number of bars from the formation of the trough. So first of all, we have this trough here on the 6th of February. Interestingly, there is another trough of just ever so slightly higher price on the 9th of February. It might be splitting hairs to ask which of those is the real trough. It is splitting hairs because it doesn't make a huge amount of difference. But as a matter of interest, I think the 9th of February is a slightly better position for that trough, because even though it has a slightly higher price, price came down very fast, and price is often a little bit like a bouncy rubber ball. When you throw it really hard, it'll go just a little bit further than perhaps it should have, bounce and then come back and settle to the correct position. So the 9th, in my opinion, is a slightly better position for that really important trough, whatever magnitude it was. Then what I do is I measure forward. So let's think back to 2 weeks ago, as price had formed its peak in early June and it was heading downwards. I measure forwards from that trough that I've identified, and on Monday the 25th of June, 2 weeks ago, I found that 136 days had passed since the trough on the 9th of February. 136 days, you should know, is the average length of the 20-week cycle. So regardless of the magnitude of the trough on the 9th of February, and that's an important point, regardless of that magnitude, because of the structure that Hurst's cycles approach gives us, because of the nominal model that we have, we know that there is a certain rhythm with which those cycles beat, and that rhythm is given to us by the nominal model. So 136 days after any trough, whether it's a 5-day magnitude trough or a 40-week or an 18-month trough, 136 days after the formation of that trough, we would expect the 20-week cycle to be influencing price to form another trough. Okay? I hope that's clear. So regardless of the magnitude of the trough on the 9th of February, 136 days later, the 20-week cycle, because it would have been 20 weeks since that trough, we would expect to be able to identify that rhythm. Of course, if the trough on the 9th of February was only a 5-day cycle trough, the fact that the 20-week cycle rhythm is repeating itself means we would only expect a 5-day cycle trough to occur again. But if the trough on the 9th of February was of at least 20-week magnitude, then we would expect a trough of at least 20-week magnitude to occur again 136 days later. If that was an 80-day cycle trough that formed on the 9th of February, we would expect another 80-day cycle trough to form 136 days later. I hope that's clear. So my point is that on Monday the 25th of June, when I was doing my sort of weekly, let's see what's going on with the cycles, I measured the number of bars, and there it is, 136 bars from the 9th of February. When 136 bars elapses, of course, as mentioned, my ears prick up and I say, okay, I'm looking for another trough to form fairly soon. Okay, and only 4 days later, price did come down and it did form a trough. Of course, we only knew that that was an important trough several days later, but now looking at it with the benefit of 1 week's hindsight, we can see that yes, indeed, that was a trough of some magnitude. We don't necessarily know what magnitude it was, but the fact is that 139 days after the trough that formed on the 9th of February, we experienced a bit of a trough in the market, and that's what we expect. So that's one way in which I apply Hurst cycles, even without really paying too much attention to the analysis that that I have on my chart. I then, of course, display the analysis, consider the options. According to this analysis, that was a 20-week cycle trough that occurred on the 6th or the 9th of February, and therefore 136 days later, I'm expecting a 20-week cycle trough to form. Okay, it's a really useful process to use, and as I've mentioned, you can identify all of the different price troughs, and you can measure from those price troughs. So here on the Thursday, the 28th of June, 30 days had elapsed. What's the average length of a 40-day cycle? It's 34 days. So we're sort of within range of a 40-day cycle trough to form over here. And from that trough over there, we measure forward and we get 57 days. That certainly would have been a fairly premature, a 10-day early 80-day cycle perhaps. And you can measure forward from this trough over here. And there you get an amount of 88 days. 88 days is not a number of days that is present in our nominal model, but it is a combination of cycles that are present in our nominal model. It could be an early 80-day plus 40-day trough, or it could be a sort of pretty much on schedule 80-day plus 20-day cycle. I think I'm rambling a little bit. I hope I've made my point. The important thing is that you measure the distance from important troughs that are formed in the market. When the number of days that has elapsed approaches the length of an average cycle in our nominal model, you sit up and you pay attention. And of course, that is really what this analysis is doing. At the foot of our chart is telling us what to expect, and we were expecting a trough to form. Okay. Now, the other thing that I like to do, and you probably know what I'm going to explain, is I like to take a look at the FLDs and the way in which price interacts with the FLDs. Now, of course, there is an FLD for each and every cycle. So, you should be doing this with each and every cycle. But I'm just going to speak quickly about the 20-day cycle, because it's certainly one of my favorite cycles to look at in terms of the FLD. So we have let's assume we have some confusion about where the 40-week cycle trough really occurred and what's going on. How can we make trading decisions despite that confusion? Well, one way in which you can do it is you have a look at the way in which price interacts with the FLD, and you identify as far as possible the way in which price does those interactions, and you measure the level at which price crosses the FLD to generate targets. Okay, so we get price targets out of our interactions between price and the FLD. So here's an A category interaction. Price came up above the FLD, generated a target over there. That target was pretty accurately fulfilled. That's a very rough estimate of that target, but you could work it out more accurately. Then for the 20-day cycle, you would expect price to find support at the FLD, which it did over here. Okay, and as mentioned, that is a B category interaction. And then you would expect to get a C category interaction as price came up above the FLD. However, something quite interesting happened over here, which is that the cycles really started getting fairly stretched out. And if we were to measure the bars here, you will find that the average length of a 40-day cycle is 34 days, and so when price came down and formed this trough over here at 56 days, that's really much too long for a 40-day cycle. So it is possible, as mentioned in our previous webinar actually, that the C category interaction was over there, and that the D category interaction was over here, and that this was the E category interaction as price came up above that FLD. Certainly, with the benefit of the extra hindsight, that seems most likely. Then we get an F category interaction where price crosses down below the FLD, achieves and exceeds its target to the downside, and we would expect a G and then H category interaction, G and H category interaction as price comes down and forms the next 80-day cycle trough. At that point, of course, we get an A category interaction coming back up above the FLD. So what's the point that I'm trying to make here? The point I'm trying to make is that if you are able to track and monitor the way in which price is interacting with an FLD, you are able to put quite a lot of your uncertainty about the exact magnitude of a particular trough at the back of your mind by studying the interaction with the FLD. You're able to make trading decisions not entirely independent of your analysis, because of course an FLD is based upon an analysis. But to some extent, you can shelve some of the uncertainty, put it in the back of your mind, and make some sensible trading decisions despite that uncertainty. Now, if you had correctly identified that this was an F category interaction as price came down, then you over here, last week, you would have been saying to yourself, well, that's probably going to be the G category interaction. Right? So therefore you don't trade it, because you don't trade G category interactions, because you expect price to find resistance at the level of the FLD and then come down in an H category interaction. So why did I so cheerfully write an A over here? Well, if you have studied the FLD trading strategy, you know that you have to be very careful of missing out on the opportunity of a good A category trade just because you are expecting a G category interaction to occur next. The way in which price interacts with the FLD is it's not black and white. It's not zeros and ones. It's not an absolute science. It's an art, really, identifying the way in which price interacts with the FLD. And when price came down and achieved its F category target at the low on this day, I think that was the 18th of June, or 19th of June, I think it came down there, when it effectively achieved its target of the F category interaction, the next move back up to the FLD could quite possibly have been labeled the G category interaction. And in fact, we had some inquiries about our Hurst signal service, which had done that, which had identified that very short little pullback. And let me just zoom in, because it does make an interesting little case study. The Hurst signal system was identifying that as the G category interaction, and then this was the H category interaction, and here was the F category interaction, of course. So why did the Hurst signal system do that? Well, because the F category interaction had actually achieved its target on this day over here on the 19th of June, it had achieved its target. So to all intents and purposes, the F category interaction was actually over. When price then comes back to the FLD, even if it's the next day, you could potentially label that the G category interaction. Price is coming back to the FLD, finds resistance at the level of the FLD, and then moves down again. So that's a perfectly valid labeling of the interaction between price and the FLD. The important thing about that labeling is it provided us with the expectation that the next interaction was going to be an A category interaction. And there are many reasons why the Hurst signal system identified it in that way. One of them, of course, was the fact that on this bar here, it had been 136 days since that really big trough, and so we are expecting a trough to form. So we should be standing by for an A category interaction. Okay, so the whole point about that discussion was that even when you have some uncertainty about the analysis and about the exact magnitude of the troughs that are forming in the market, you can use the way in which price is interacting with the FLD to guide you and to help clarify your analysis, but also to help make sure that you are making the right trading decisions at the right time. So let's wrap up this discussion and consider what is going to happen next. You've probably realized over the past many months as we've been discussing the analysis that Hurst cycles analysis process is a constantly evolving process. You're always looking ahead to the next trough and to the next peak. As price bounces out of a trough, there's always another peak waiting for it, and it's going to rise into that peak and then turn around and come down again and then form another trough. It's a constant process, of course. So let's take a look at what we're expecting next. So let's turn on the composite model line. So here's a composite model line for our default analysis, and it's providing quite an interesting and not really a very good resemblance of the price action that has happened. So let me just quickly again remind you, or if you're new, tell you about the composite model line and what it is. The composite model line is constructed on the basis of the analysis that is on the chart, and it takes the wavelengths and amplitudes of all the cycles that have been identified, and it then recomposes that cycle information and builds a price action that would have resulted if the only thing that was influencing this market were the cycles that have been identified on the chart. That's what this line is. So there are times when the composite model line is extraordinarily accurate, as you can see, which means that at that time the cycles that have been identified on the chart were influencing the market, and there weren't very many other influences. And then there are other times where you get quite a big sort of a divergence between what the composite model line is telling you and what the price has actually done. So here you can see there's rather an interesting sort of a divergence here, which is really brought about entirely by this sort of sharp move down here over these 2 days. So the entire price movement sort of slipped a gear, if you like, and dropped down. And if we zoom in on the period of time following that, I think you will find that the composite model line will match a little more closely what has been happening with price. Okay, so that's not magic, what I just did. The composite model line is plotted over the price that you're showing on your chart, okay, to show you how the cycles that you're seeing at the current zoom level, how the cycles that you're seeing at the current zoom level are in fact influencing the price action. So if we just go back again, you can see how this composite model line, although it looks as if that's deviating badly from our price action, is actually giving us a fairly good representation of price action. It's just sort of dropped down over that little period of time over there, indicating that the price action that happened over there wasn't price action that was purely derived from these cycles that we can see. Okay, so let's just zoom in again, and we can have a look at what the composite model line is saying on this analysis. So you can see here's the peak in early June, and the composite model line here is saying that the peak that's about to form now, which is that nest of lows over there, was kind of expected to happen lower, so it shouldn't exceed that peak. But that's by no means something to be taken as law. Price could definitely come up again. What's more important is the sort of general shape of what's happening here. So we're expecting a little bit of bouncing around. We've got a bit of a trough here early August, and then we're getting a move up through August into early September to form a peak. That's what that composite model line is telling us. And if we go to our other analysis, we can look at the composite model line here. This composite model line is matching more closely the price action that has occurred. Although interestingly, we are still getting a bit of a drop down over there. So clearly in the middle of March, something non-cyclical happened, if you like. And so here's the composite model line giving us this move up to the trough. This is expecting move up from the trough to the peak. This is expecting a higher peak than the peak at the end of at the beginning of June. So that's quite possible. Of course, it's that 20-week cycle peak over there. So we're looking for a move up into a 20-week cycle peak, which is expected to form soon, and then we're looking for a move down into early September. And so we're getting a slightly different projection between this chart and the previous chart. And let's just take a look at one more chart, because many of these analyses are providing us with only a few possible options. Here is a similar scenario to the previous chart, where we have a peak here expected to form fairly soon. Then we're getting the move down into early August, and then we're getting the move up into early September. So the general structure of the market, according to this analysis, is similar to the first chart that we looked at. Okay, well, let's take a look at the others just for the sake of completeness. And here you can see we have a similar situation in that a peak is expected to form now, and then we're looking at a move down into September, and then a move up. I hope you're seeing that we have two possibilities that are being highlighted by our composite model line. They are telling us over the next period of time, and let me just clear this, that we have basically two options. They're all effectively telling us to expect a peak to occur fairly soon, which is the peak at the beginning of July, early July, that we have been expecting. And then we have, from that point, two possibilities. One is a move down into early August, followed by a move up, and the other one is a move down into early September. So those are really the possibilities that are provided to us by all of these analyses. So what should we be doing? Well, we are certainly going to ride this upward move, but we are definitely on the standby for a peak to form, because our analyses are all telling us to expect that peak to form fairly soon. When that peak does form, we need to watch what price does to see whether we're coming down into a trough only at the beginning of August, or whether that move is going to extend down into early September. So that is the outlook that these analyses are providing us with at the moment, and that's what we should be expecting as we move into the next couple of months, summer in the Northern Hemisphere. I do hope that you have found this interesting. Let's see whether there are any questions that I can answer. All right, so a question from Stephen saying, how do you deal with imperfect cycles or wave matching on a chart? Is the primary approach to try to pin various waves, 20-day or 40-day, at points that an analyst believes is appropriate? And Stephen's saying that he is new to Hurst cycles. So that's a great question, Stephen, and actually it lies at the heart of everything that we do as Hurst analysts when we're performing an analysis. And I'm going to give you a sort of a brief overview of what the answer is to that question. But I did record a series of webinars or recorded videos that go into this in greater detail. So I'd encourage you to have a look. They're on our YouTube site, which we're busy organizing a little bit better at the moment. So you should be able to find them. There's a playlist for performing a phasing analysis manually. So I hope you'll find that useful. But I've just pulled up a whiteboard here so that I can there we go. So that I can explain the basic process. What happens when you're performing a Hurst cycles analysis is that you're using a pattern recognition approach. This is according to the way that Hurst taught the analysis process in his cycles course. You use a pattern recognition approach, and the first thing that you do is you identify all the longest cycles that you possibly can in your analysis by placing diamonds underneath them. So what you do is you get a strip of paper and you measure the number of bars, and you do your best visually using effectively pattern recognition to identify the longest cycle troughs that you can in your chart. Okay, so let's say that's an 18-month cycle. I'm trying to use a mouse instead of a pen. It's a little tricky. Okay, so you identify the longest cycle troughs that you can, and some of them you won't be able to identify. So you'll position question marks, often sort of closely clustered together if there's some confusion about where that trough is. Then what happens is that you work down through the shorter and shorter cycles. So then you will find the best fit for the 40-week in between the 18-month cycles, and then you'll find the 20-week and so forth. You'll go all the way down to the shortest cycle that you can analyze, which is the 5-day cycle on an end-of-day chart. And in the process, you will perhaps find a 40-week cycle over here, and in that process you will be able to resolve the positions of these question marks, and you can then cancel out the question marks that have been left there and plot a nice confident diamond. So I hope that answers the question. So yes, effectively what you do is you do pin the cycles that you believe, the troughs that you can identify, starting with the longest cycle, and you work down to shorter and shorter cycles. And there's a particular logical process that you follow in order to do that process. It's the phasing analysis process, and that's how that works. So I hope that answers that question. This is not really a question at all, but this is a comment from David F, and I thought it would be useful just to mention it, because I didn't show any of the extra FLDs. I had so much to say, I never really got around to looking at other FLDs and VTLs and so forth. But he mentioned that the SPX is clinging to the 40-week FLD, and he mentioned that he thought that the recent trough was the 20-week trough and the 40-week trough was in February. So I thought, let's just quickly show that. The comment was about the 40-week FLD. Here is that 40-week FLD. Isn't it really interesting how price has been responding to this 40-week FLD all the way since February. So this is on a daily chart, the 40-week FLD on a daily chart. And you can see how recently price has been really tracking that 40-week FLD with absolute accuracy for the past, about 2 weeks. For the past 2 weeks, we've been really seeing tremendous accuracy on that 40-week FLD. Of course, a better way of considering the 40-week FLD is to look at a weekly chart. So there's the 40-week FLD on the weekly chart, and look at how in February it came down to the 40-week FLD on the weekly chart, and ever since early April, price has been really tracking along that 40-week FLD. FLDs are extraordinary things. I do enjoy looking at them. So this is a comment from Robert, and I thought it is something that needs mentioning and speaking about. It was a comment made towards the end of the video when I was talking about the different interactions with the FLD and the interpretation of those interactions. And Robert made this comment that in the past few weeks, the Hurst signal system, it's been shifting from sort of one analysis to another. Now, that is something that occasionally happens, and let me use a whiteboard just to show you why it is. In fact, what I'll do is I'll quickly use the chart that we uploaded. There we go, the daily chart, and I can show you why that kind of thing happens. Okay, let me change the color on this pen. All right, and draw. Okay, so as you can see, we've got various troughs here at the foot of the chart. Okay, and in this particular analysis, it has identified them as 40-day and 80-day. Okay, but as you know from our discussion, both in this webinar and in previous webinars, it is possible that those troughs are of a different magnitude, and it's something that we're constantly monitoring. So what will happen is that a price action will make a slightly different analysis a more favorite analysis. For instance, something that might happen, it hasn't actually been happening, but something that could happen is that it will say that the trough in June was an 80-day cycle trough, whereas the trough in May was only a 40-day cycle trough. And I'm not going to waste time explaining why that's possible, but I expect that you can sort of figure that out for yourself, that because the 40-day troughs are 40 days apart, one of them might be the 80-day trough, or the other one might be the 80-day trough, depending on what's happening in the rest of the analysis and in recent price action. So when that happens and the analysis shifts, then of course your interactions with the FLD need to be relabeled, because the interactions between price and the FLD are labeled on the Hurst signal system from an 80-day cycle trough. So if the 80-day cycle trough moves because of a reconsidered analysis, then the identification of those interactions will have to be adjusted. When that happens, what you will find is that the interactions will change, for instance, between an A category interaction and a G category interaction, or perhaps a D category interaction and an F category interaction. So you will notice that those are interactions in the same direction, of course. Okay, the only difference is that an A category interaction gives you a good, profitable long trade, whereas a G category interaction doesn't. So when you get the interactions shifting like that, you need to consider what is the best trading opportunity here, which is one of the reasons why the Hurst signal system, whenever it references a G category interaction, will often, if it is possible, it will say, bear in mind that this could be an A category interaction. Because whenever you're approaching a G category interaction, you need to consider the possibility that in fact it is an A category interaction. I hope that explains that in terms of why the Hurst signal system will sometimes jump from one analysis to another. Sometimes it'll go back and forth between them. And also when those interaction letters change, it might seem like a big thing, but usually, if not all the time, the interaction is still a short trade, or it is still a long trade. In other words, it's the same direction trade that is being referred to. The only difference is in terms of the degree of your expectation. So a D category short trade is a nice short trade, but it has limited reach. If the system changes and says, actually, we think that's an F category trade, there's no problem, because you're still in the right trade. The only difference is that you have greater expectation for where that could go. Dale asked a question, wouldn't you expect the current 20-week cycle to beat with the same magnitude as the previous 20-week cycle rather than the nominal model? And I asked him in the chat window if he was referring to the wavelength. So I think the question is actually, don't we expect the current 20-week cycle to beat with the same wavelength as the previous 20-week cycle rather than the nominal length? It's also a great question, and I'm going to have to do some more drawing on this, because when you have a 20-week cycle that beats with a certain rhythm, here we go, it has an average length. Okay, and that average length is 20 weeks. All right. Then when you get one of these cycles occurring early, so let's say that this cycle actually occurred early over here. All right. So then you have a situation where this cycle over here, this iteration of that cycle, is really short. Okay, so let's say it's, for sake of argument, let's say it's 15 weeks. So the question really, okay, I'm not going to use that pen, it doesn't really like that pen. Sorry about that. 15 weeks, okay. So that's a 15-week cycle instead of a 20-week cycle. So the question then is, what is the next cycle going to be? And there are two arguments. The one argument goes like this. Because our average length is 20 weeks, that means that following a short cycle, you must have a long cycle. So therefore, the next wavelength must be 25 weeks. That's the one argument. Okay, and the other argument is that because recently the 20-week cycle has been beating with a shorter wavelength, a 15-week wavelength, we assume it will continue to beat with a shorter wavelength. So therefore, we assume it will beat with a 15-week. It'll be a 15-week iteration of that cycle. Those are the two different arguments. Honestly, it's impossible to resolve that argument, because over time we expect the wavelength to average the nominal length, which is 20 weeks. Okay, but we know that cycles change their wavelength slowly, so therefore we have some expectation that the cycle will continue to beat with a 15-week wavelength. So the answer to that question really, Dale, is that if you choose one or the other, if you say, because the last one was 15 weeks, the next one will also be 15 weeks. Sometimes you will be right, and sometimes you will be wrong. Okay. If, on the other hand, you take the alternative approach, which is that because the recent wavelength was 15 weeks, the next wavelength must be 25 weeks to achieve the average, sometimes you will be right, and sometimes you will be wrong. So, in my experience, the best approach to use is not to assume that the short wavelength will continue or the recent wavelength will continue, and not to assume that because recently we've had a deviation from the wavelength, we will have the converse or the opposite wavelength. The best thing to assume, in my opinion, is that we will always have a nominal wavelength iteration of each cycle. Sometimes it will be short, sometimes it will be long. I hope that answers that question. Okay, and here we go. So Robert mentioned something. Again, this is not a question, but he mentioned that he uses support and resistance. And I just wanted to mention again, I've mentioned David Weiss and his work in several previous webinars, and he works a lot with support and resistance. And Robert mentions here a volatility stop. I just wanted to sort of drop the seed in there that it's well worth combining your Hurst cycles analysis with other approaches, particularly approaches that have to do with support and resistance. I think that's a really useful useful thing to mention. And Stephen asked, for trading purposes, do you have to match the 20-week FLD to the 20-week cycle for trading, or the 40 to the 40, etc.? Yes, so Stephen, an FLD is a really simple line. Okay, it's a magnificently simple line. It is, in fact, simply price displaced into the future. So it's the median price, the mid price between the high and low of each bar, displaced into the future by half of the current wavelength. So the trick is you need to calculate the current wavelength. And in order to calculate the current wavelength, you need to have performed an analysis. And so, yes, indeed, the 20-week FLD is based upon the current wavelength of the 20-week cycle in the analysis at the moment. Okay, so I hope that answers that question. And on that note, it's been a long webinar. Thank you very much for joining me. Thank you for your time. Thank you for your interest in Hurst cycles. This is the final webinar in this season, if you like, the series of webinars. I am coming back with a slightly different format. If you have any ideas for how I can make these webinars as useful as possible to you, then please do send me an email and let me know how best I can serve the Hurst Cycles community with these webinars. So thank you very much, and I look forward to seeing you next time.